Hi everyone, Kathleen Brooks here, Research Director at XTB in London. What a few days for markets. They were selling off sharply at the end of last week before making a miraculous recovery at the start of this week. Let's take Nvidia, the AI giant, as an example. It was lower by 10% on Friday before bouncing back by 5% on Monday. The $2 trillion sell-off in stocks last week had no fundamental triggers. There is some nervousness around earnings releases, and this is the busiest week for earnings releases, with 40% of the US S&P 500 reporting. There were also concerns around valuations, with AI and other tech stocks selling off broadly. However, the bounce back, which is triggered by activity in the options market and some signs of algo trading, suggests that the sell-off went too far. The S&P 500 has sold off for 3 straight weeks, which is rare historically, so stocks were due a pullback. The truth is, it's really hard to value stocks right now. This earnings season has seen some big sell-offs on the back of minor blips in earnings reports, for example, for JP Morgan and Netflix. The market is priced for perfection, and when that's not delivered, stocks get punished. Interestingly, expectations for earnings in the S&P 500 in the US have been cut to 2.4% from 4%. The bar may have been lowered for Q1 earnings, but make no mistake. The market is focused on forward guidance, and that needs to be strong. Otherwise, markets are willing to ditch a stock. This week, we see some key releases, including Meta, Tesla, Alphabet, and Microsoft. All eyes will be on AI and if it's making a positive contribution to the bottom line. The market is expecting the worst from Tesla. Analysts have slashed expectations, and earnings are expected to fall 40% year on year. The company has cut prices and laid off staff, which is not a good sign. However, Tesla's stock price has already fallen 40% so far this year, so if results aren't as bad as expected, then we could see this stock attempt to make a recovery. Elsewhere, the FTSE 100 made a record high on Monday and is holding up better than other indices during April's volatility. The FTSE 100 is benefiting from 2 factors. Firstly, it has defensive qualities which support it during times of turmoil. Secondly, it makes a large chunk of earnings in dollars, so when the pound is weak, this can benefit FTSE 100 companies. At the same time as the FTSE 100 made a fresh record close, the pound-dollar exchange rate plunged to its lowest level since November last year. Now, the markets have been rocked by shifting expectations for interest rates, with fewer rate cuts now priced in for the major central banks. The reason markets could be rallying this week is because the Fed is in a quiet period ahead of their meeting next week. This could press pause on their hawkish rhetoric for a few days and allow the markets to recover. There's also a decent amount of economic data due this week. The first look at April PMIs are worth watching, along with US PCE, the Fed's preferred inflation measure, and the US Q1 GDP report. That's all for now. Thank you for joining.